Hey guys, Eddie Wilson here with Think Realty. Thank you so much for joining us on the podcast today. It's our privilege to bring you some great guests and some great content for you along your investing journey. We love being a part of your investing journey and want to make sure we provide lots of value to you. I want to say a quick thank you to our podcast sponsor, which is Real Property Management. Real Property Management is a fantastic property management firm nationwide that can help put more money in your pocket versus taking money out. If you're not happy or satisfied with your current property manager, you might want to give them a call or visit them on the web at Real Property MGT. That's realpropertymgt.com. Thank you so much for sponsoring the podcast, Real Property Management. It's always a privilege. For me, this is an interesting time for real estate. I'm a third generation real estate investor, and I'm super excited to bring on someone who has actually helped me along in my journey. And so today on the podcast, we have Damon Riehl. Damon, thanks for joining us today.
I appreciate being here.
Yeah, Damon has a company called LoanBidz, and LoanBidz with a Z.
LoanBidz with a Z.
LoanBidz with a Z. I always point that out when I'm sending people to your website. And Damon has aggregated private lenders across the nation to provide you, as a broker, a way to find access to the best money, the cheapest money, the fastest money, whatever it is they're looking for. And I know you work with a lot of the top private lenders. So if you don't mind, just for context, explain the platform, how they use it.
Sure. LoanBidz.com, really, as Eddie mentioned, we aggregate the programs and the pricing from pretty much all the top private lenders in the space. And the private lenders then provide us what I call wholesale pricing, meaning that misconception that many of the real estate investors have is that if you go to a commercial mortgage broker, you're going to pay too much. You're going to pay extra points and fees and that sort of thing. But the way that LoanBidz does it, and the way that many of the established commercial mortgage brokers work, is on that wholesale basis. They can get that discounted pricing, add a little bit for their activities and the fees that they need to make, and still be highly competitive with with really even direct lenders in the space. Yeah. So that entire perception that brokers are too expensive, really, I would challenge that and ask you to consider.
Yeah, I've used you guys as well, and I own the American Association of Private Lenders. I have access to all kinds of private capital. But in the end, there's something to be said about somebody who's aggregating lenders. Yes, I could go direct to them. However, if I'm not doing volume, then they don't have necessarily a big benefit to give me the best pricing. And so I know even some of the difficult properties that we've had to finance, like you've done a great job, or your team's done a great job.
Thank you.
And finding us the right lender to finance our deals, whether it's, and some of them are difficult, like we had some in Indiana that our appraisals didn't go well, and you guys helped us with that. And then we had some new construction ones that were turning into short-term rentals, and you helped us with those. Those are difficult sometimes, and so you guys really have two primary verticals, right? Like you do a lot of DSCR, right, which for everyone else that's debt service coverage ratio, meaning that they're lending based on the performance of the asset. And then you do a lot of fix and flip. Are those the two primary verticals?
I would say that we also do new construction as well. So really any short or long-term loan for single family, multifamily, mixed use, and commercial, really we have options for.
Yeah.
And what I would say is those options are everything from, what I would call tier one, or the best of the best, for those clients who have a great profile, experience, and liquidity. And then we have various tiers. So if you're an investor that's new in the business, or you're a little light on your liquidity, or you're looking at a little bit of an odd property, we will have some options for you, most likely.
Yeah, let's talk about the elephant in the room right now, and that is rates and rate movement and rate volatility. How important is it to have a relationship with lenders or someone who has access to capital right now, because things are moving so fast?
I think it's really important to have a stable of consistent lenders who have diverse capital sources. So I think we have the best of the best. If you look out in the marketplace, 8 of the top 10 private lenders are on our platform, and we work with them regularly. But from a rate standpoint, again, it's all about those capital providers. And for us, we spend all day, every day, looking through who's the best each given day. As a matter of fact, on our website, REI News Now, we post a weekly rate survey for a lot of these different products. So if you want to check that out on a weekly basis, we'll update that and show you where the best of the best are pricing those particular deals.
Yeah, and I think that your REI News site is really important for them to log and kind of connect to, because that rate survey that you're publishing is an aggregation of all the lenders that are willing to give you the data. But then they can kind of see if they're getting quotes. I mean, I would start there, because if they're getting quotes higher than that survey, then they really should be coming over to LoanBidz and let you guys be, a broker to them to try to get them close to that rate. And obviously there's a lot of criteria that goes into how you get those rates and stuff like that. But I think it's really important. Now, what I like to say too, and I think it's so important, I'd like for you to speak to this, is that if you're a real estate investor, rate should not concern you as much as yield or appreciation. Meaning, I'm an investor, and so primarily the repayment of the loans that I'm taking, I'm not participating in. My tenants are, and so it doesn't, and it maybe shouldn't matter to me as much, because if you're waiting for great rates again, I don't know how long it'll take. I mean, if it'll be a full real estate cycle, I don't know if it could be 20 years. We don't know what rates are going to do. I think a lot of people want to say they know what they're going to do, but the reality of it is everybody that said that they knew what they were going to do last year was all wrong. And so why would we even try to speculate? So as opposed to staying on the sidelines, it's more about finding, in my opinion, great deals that can withstand whatever the rate is. Like, what do I care if I'm paying 7, 8, 9%, as long as the debt service, especially on DSCR loan, as long as my debt service coverage ratio is higher than that, I'm playing at a 1.1 or a 1.25, whatever it is, it's like, then I'm still getting an appreciating asset and I still have yield or cash flow, and so exactly. What do you think about that?
Yeah, I think that's true, and I think there are a lot of our investors right now that are looking at deals, and they are having to comb through more deals to find the ones that really cash flow the way they expect. Mm-hmm. I tell you, we bought a few properties last year, and around the 200,000 price point, mm-hmm. and those particular properties, we were able to get rates in the 5%. Mm-hmm. Now those rates would be in the 7 to 8%. Mm-hmm. Our cash flow would be different.
Sure.
Instead of making 400 or 500 a month in positive cash flow,
right.
You might be 200 or 300.
Right.
And in those particular instances, yes, you probably need to be a little bit more diligent in picking the deals that you want to do. But as Eddie said, the lenders are not going to allow you generally to do deals that don't make sense, mm-hmm. because they have risk parameters. They don't want the loan to default. So if they're going to try to help you along the way, and if they see some concerns about the project or the property that you bring them, they're going to bring it up. And most of them today will not go below, as you said, a 1.0 DSCR, and meaning that they've got to at least break even cash flow in order to do the deal.
Yeah.
So I agree with you. I mean, we're still looking for properties. We were looking at some yesterday. So situation where I fully agree that you got work harder, work smarter, and the deals will be there.
Yeah. I've told a few people this, and my CFO knows this, but I've doubled my net worth in every in any economic downturn. So I started investing in the .com boom. Then I invested heavily through 2008 through 2010. I invested heavily through COVID, and then our goal within this calendar year is to double my net worth again. And it's like, because when everybody else is running out, if you play the game right, you play it like an investor, not a consumer, exactly. the opportunities are there. And the capital providers are readily available. And I think that that's a misconception, is that, capital's scared. capital's not scared right now. Wall Street's coming in with a vengeance right now. There's $1.1 trillion sitting on the sideline in liquidity in private equity funds. These private equity funds are trying to find yields, so they're pushing their money towards real estate. It's like there's so much capital being forced into the real estate market, the build to rent craze. It's just like everything. And it's like, you're either going to get your piece of it, or you're going to sit on the sidelines and watch somebody else get their piece of it, you know. And so I love that you provide that resource for them.
Yeah, and I agree that right now with some of the banking issues going on, maybe some of those small regional and local banks that typically helped investors may be moving a little bit to the sidelines, and that means that this private capital that is available through LoanBidz and through other lenders is really going to be that much more important.
Yeah, it is. It was in 2008 through 2010. Actually, go back to really 2011, 12, 13, to me was the highest growth period for private lenders. And what it was you had a massive vacuum that was created by the new Dodd-Frank regulation. Yeah. And so banks were highly regulated in what activity they could get involved in. And so private lenders stepped up. Wall Street followed on. They're like, oh, if you can kind of create the right model, we'll put capital in this. So now DSCR, I mean, primarily the DSCR programs are funded by Wall Street and big institutional capital. They want to play deep into that game. It's the best yield that they're receiving right now. And I actually believe that this next year, we're seeing a lot of shakeups in the private lending space, right? Like we're seeing guys that just weren't positioned, they were not well capitalized or funded. We're seeing people kind of shut things down, they're trying to reemerge. I think you're going to see, and you have some of the largest private lenders in the nation right now being courted by large institutional banks to purchase them, because in the end, their model looks fantastic to the bigger institutions. And so I just think that we are in a space right now where banks can't serve us. It's been a long time since I use my bank for lines of credit and all this stuff in my private equity stuff, but I haven't been to my bank to talk about a real estate deal in probably 4 years, because private equity or private capital, private lending is so readily available and so pliable, It
is, and it's gotten so much cheaper.
Yeah.
Over the years as it's gotten institutionalized in Wall Street.
Yeah. So I think it's interesting, and I think that you are going to be at the cutting edge of kind of aggregating all those changes, because the guys that were with some of these companies that recently just went out of business are now scrambling to find new relationships. And there's still some giants to fall, I think. We're going through a rough time. I mean, and things are shaking up, and so it's far better to be with somebody who has 30 or 40 potential lenders versus you've got all your eggs in one basket, which I think is a huge service.
And I think one of the things that we're seeing is, because we deal with so many lenders, is ones who are highly competitive, in the last cycle and last year, they're not that competitive right now, and other ones have kind of stepped in and taken their spot. So that's the beauty of what we do, is we can see that, and we can help our clients to be able to navigate those new best-in-class programs that are available.
Sure, yeah. So if you had a crystal ball, what's on the horizon? What do you think's going to happen? I mean, what's your sentiment in real estate over the next 12, 18 months?
Well, if you're talking about rate-wise, and I think that hopefully, as we're here in mid-March, hopefully the Fed is close to being done with what they're going to do. They've still got some of their bond portfolio to sell off, but hopefully the benchmark for the DSCR, which is typically either the 5 or 10 year, depending on the lender, hopefully that's moderated right now, or it's at least settling in. And I think that when I started in this business, those long-term 30-year fixed loans were in the 7-8% range, and we did a lot of them. And yes, we had a great time when rates were down in the 4 and 5%, but we and our investors can still do a lot of business with this particular type of economics, as long as the capital stays available. That's the biggest.
Yeah. And you think it will stay available?
I do. in my experience, which has been long, I lived through the '08 type of thing, and typically in the world of lending, it's a liquidity issue, just like it was with the banks, where something occurs, maybe it's a credit event, and the buyers all of a sudden say stop. We saw that during COVID, where they thought, oh no, nobody's going to pay their rent checks or their rent payments anymore, and the landlords aren't going to be able to pay, so we're going to stop. And there was really a 2 or 3 month period there where Wall Street was not buying, lenders were not lending, and then they saw that the world didn't end, and by the end of the year things had come back and were pretty consistent again.
Yeah. There's not enough yield for the capital that's out there. I don't see how it can go away. Because I just don't know where they put their capital, And so, I think that's a good sign. One last question. I know we're kind of close on time, but we need to wrap up. But the Federal Reserve, it seems like Jerome Powell is just kind of steady as she goes. He's just going to keep raising rates until he hits, some sort of a threshold. For inflation. But you think he's going to see the world differently with some of the banks failing and things like that? Do you think if we see a leveling off real fast, it shows that there are bigger issues in the banking world? If all of a sudden we start making choices based on where our banks are versus where our inflation is, do you think that gives any indication? Or what do you think that story is that's being told?
I think that, quite honestly, I'm surprised something didn't break earlier with all the 75 basis point moves and how quickly things have gone. And I think the Fed was kind of waiting and watching for what that first thing was going to be.
It's almost like a stress test.
Yes, like a stress test. And now they've had a little bit of a stress test here. They've lost a couple pretty significant banks, and now they're going to be a little bit more careful. Luckily, they admit they're getting close to the end of their raising cycle. So hopefully, today's the day. I don't know if you even know yet, but they went up 25 basis points today, and
right.
It's going to say they're coming to the end of their cycle. So,
let's hope so.
Yeah. So I think from a mortgage rate standpoint, I would love to say we've seen the highs on as far as rates are concerned. Don't know that that's necessarily true, but I think we're probably pretty close.
Yeah, very good. Well, thank you so much for what you do for the industry. Thank you for your insight. Appreciate you being on the podcast today.
Thank you.
Yeah, absolutely. Think Realty, thank you so much for being a part and watching and participating. We love that you're involved and invested with us. If you can, please comment. Let us know what you want more of through all of our social channels, whether it's LinkedIn, Twitter, Facebook, or Instagram. We'd love to hear from you. Thank you again to our podcast sponsor, which is Real Property Management. Real Property Management is a fantastic property management firm that if you're not satisfied or happy with the current property manager you have and you don't want to do it yourself, Real Property Management will put more money in your pocket rather than take it out. A good property manager always will. And you can find out more about them by going to Real Property MGT. That's realpropertymgt.com, and you can see the real property difference by going there and engaging with them. Also, if you haven't bought your tickets for Tampa yet, we've got the Tampa conference coming up July 13th and 14th. It's one of the hottest markets in America for investing today. It's blowing up still. Florida is still hot. There's still lots of demand down there. And we want to go see what's going on by having a conference and an expo there. We've got great experts coming in to speak and teach. We've got capital coming in. We've got deals and opportunities for investment coming in, as well as some resident experts to teach you and help you, guide you along your investing journey. If you use the code PODCAST, PODCAST, we'll give you a buy one, get one free on those tickets. And that's the best deal you're going to find right here on our podcast. Thank you so much for being a part. We'll talk to you soon. Stay in touch.